Hello everyone, welcome back to Gain Grow with Gustavo. Now before I continue on with this video, I want to say thank you to everyone who has been subscribing to the channel, those who like the video, and those who have been sharing the videos as well. It really helps the YouTube channel to grow and I appreciate it. And also, this is my dog Princess. She's joining us today. Now in today's topic, we're going to talk about stocks. And there's a variety of different ways on how you can invest. Obviously, there's day trading, there's option trading, investing for the long term, short term, medium term, and also other various ways in how you can trade within the stock market. But today specifically, we're just going to talk about the strategies that I use specifically, which is long-term investing. The way I invest is pretty much I buy X amount of shares of a company and hold it for a long period of time. Reason why is because, relatively speaking, if you're a day trader, statistically speaking, 9 out of 10 times, most day traders lose money. Most of them, yes, make that big one huge gain, but over a long period of time, they do lose a good amount of money. And that's not the way I play. I'm not saying I play the game conservatively, but I much prefer playing the game like Warren Buffett. Now, majority of us know who Warren Buffett is. He's a long-term investor who has been investing for a relatively long period of time and tends to play a very safe game within the market. And that's specifically my approach. I'm not trying to get rich quick. I'm trying to get rich wisely. And that's the way I think most individuals, most Americans should approach investing within the stock market. All right, now the way a stocks works is that pretend there's a pizza, right? You have a pizza and there's 8 slices and you consume one of those slices. Well, you now are a partial owner of that pizza, or in this case, that company, because you consumed part of that slice, right? You own it. You own that slice now. But over time, this price, right, that you paid for, let's say it's $5, will either appreciate or depreciate. And the way that works is based off their earnings. Companies will report earnings every quarter in order to give their investors a clear understanding of how the company is running, right? Whether they're increasing sales, decreasing sales, going into new markets, investing into new equipment, into new research and development, whatever the case is. They'll do these reports in order for their investors to have a clear understanding of what they're investing in. Now, when it comes to those reports, investors like myself and others will decide whether we want to keep holding that slice of pizza, or do we want to sell it to somebody else, or do we want to buy more. So those are usually the options that we're given, right? We could either buy more or hold on to the same slice of pizza or sell it to somebody else, whether at an increase or decrease price. All depends. Okay guys, now before you move on and start investing within the stock market, I made an Excel sheet with graphs and also selected 4 categories in order to give you a visual understanding of how much you could have made if you would have invested from the periods of 2016 to present date. Now, the 4 categories that I selected is aggressive growth, growth with dividends, and mature with dividends. Now, within those 4 categories, I made sure that they were all equivalent to the data that I collected. Now, this data contains the 52-week low and the 52-week high. What it represents is a year span within the stock price. Its lowest price, which is the 52-week low, and its highest price, which is the 52-week high. Now, with growth with dividends and mature with dividends, I put a 14-year span because obviously you will be receiving dividends annually. So those numbers might be a little bit different compared to the aggressive growth and growth category. Now, within each category, I did select 3 companies, and within those 3 companies, you'll have a hypothetical share purchase of 20 shares. Okay, so you would have a collective total of 60 shares per category. Now, I also selected 2016 prices, but only Amazon and Tesla was traded publicly throughout that time. Zoom is a relatively new company that went trading into the public markets in 2019. So obviously, I had to pick their price range from 2019, but for Amazon and Tesla, I did pick a price range from 2016, so you can have a visual understanding of how much you could have made if you started investing the same time period that I started investing, which was the year 2016. So let's move on and let me show you the chart with aggressive growth. Now, as you can see here, the 52-week low is in blue and the 52-week high is in orange. Now, if you see the total earnings down there, Amazon would have brought you about 35, close to 30, more towards $34,000. Tesla would have brought you close to $32,000, and Zoom would have brought you about $4,400. A total of $70,000 in total earnings. Now, let's check out if you would have invested in these companies from the time period of 2016 to 2019. So remember, it was about $70,000 that you would have made, but let's look at the chart now. It increased by about $18,000. So your total earnings would have been $88,000. Close to $89,000 is $88,605 with 60 cents. So if you round it up, it's close to $89,000. Now the same thing is going to be implied with growth. It's going to have the 52-week low, the 52-week high, and their stock price from 2016. Now, within the growth category, the three companies that I selected was Adobe, AutoZone, and Facebook. Now, Adobe was trading around $255. AutoZone was about $280, and Facebook was around $140. So let's look at the graphs. And the same thing implies. The blue is the 52-week low and the orange is the 52-week high. Now the total earnings would have been about $18,000. Adobe would have brought in about $4,000. AutoZone would have brought you close to $12,000, and Facebook would have brought you close to $2,300. So within each category, you will be seeing a change to your total earnings. So as you can see, if you would have invested in growth back in 2016, it would have added about $2,000 to $3,000 more if you would have held those stocks till present date. So let's move on, and the next category is growth with dividends. Now, like I mentioned before, growth with dividends and mature with dividends have a 14-year hypothetical time span, because you are also going to be receiving dividends annually. Now, with growth with dividends, I selected Activision, Nvidia, and MasterCard. Now, with Activision, they tend to reward their investors with a dividends annually. And Nvidia and MasterCard tend to reward their investors quarterly when it comes to their dividends. Now let's look at their chart. As you can see, Activision, their 52-week low is in blue, and so is for Nvidia and MasterCard. And their 52-week high is in orange, and their earned dividends is in gray for a 14-year span. Now, I'm showing you the total earnings that you could have possibly made if you would have invested from their 52-week low all the way to their 52-week high, and you would have had about $10,000. Now let's change it up with their stock price in 2016. If you would have invested in all of these three stocks, Activision, Nvidia, and MasterCard. Now let's look at the graph. It took about a $4,000 increase on your total earnings. It went from $10,000 close to $15,000, but it's $14,668.20. Now, as you can see, obviously, the amount of your total earnings would have increased because the price share was dramatically lower than what they're currently trading. Now, if we go on to the next category that I selected, which is mature with dividends, these are companies that have a relatively good amount of time within the public sector, and they have been rewarding their investors for a good amount of time throughout years of recessionary periods and also booming periods within the economy. So the three companies that I selected was AT&T, Bank of America, and Hanes Brands. Now their 52-week low and their 52-week high is also implemented in here, and the same goes with the dividends. So let's go with their chart. Now the 52-week low is in blue, the 52-week high is in orange, and the earned dividends, which is a 14-year span, is in gray. Now when we move on to the total earnings, you would have had about close to $1,800, which is not bad, but you have to remember these are companies that have steady growth. They don't really grow at a rapid pace when it comes to double-digit earnings like the other companies that I have been presenting, but their stock has been appreciating slowly, but their dividends also makes up for that slow appreciation. But let's look at if we change the time periods. If you would have bought these stocks in 2016 and held them till present day into their 52-week high, as you can see, you would have lost about close to $600 when it comes to your total earnings. Obviously, the total amount decreased. It went from close to $1,800 to about $1,300. Obviously, I'm rounding up these numbers, but you can also take a notice that Hanes brand has went into negative territory. You are down about $82.80, which is not a lot, but as you can see, due to the dividends that you have been receiving, it covers those losses. Now guys, before you go off and start investing within the market, I do want to just go over some main points. And the first point that I want to talk about is, what is a stock? Well, a stock is like what I mentioned before. A share of a company is essentially like a slice of pizza. But there's millions of shares being traded daily, Monday through Friday, from 9:30 in the morning to 4:00 p.m. in the afternoon, from institutions and individual investors like myself day to day. So the prices will fluctuate. Now, the second point is how to make money off a stock. Well, there are essentially two ways in how to make money off a stock. And the first one is appreciating value. Some companies do so good that their value of share appreciates dramatically over a short period of time or an extended period of time. Now, just like there's a appreciating value, there's also a depreciating value. Not all companies tend to appreciate in value when it comes to their share price. Some companies do depreciate in value, but that's because they're not performing well as a company. So shareholders and investors are just looking at the company as a whole and noticing that they're burning more money than what they're bringing in. And the next form of making money is dividends. Now, when it comes to dividends, you can think about this as an interest payment. Companies will issue these dividends monthly, quarterly, semi-annual, or annually. Now, not every company pays this form of dividends because some companies much rather reinvest their profits back into the company in order to grow more rapidly. Or two, if they're a mature company, right, they'll tend to reward their investors with this form of payment. Now, this payment is not always guaranteed. Why? Because obviously some companies do run into some trouble and may have to cut the dividends from investors. A great example is Boeing. Now, another thing is this dividend payment is issued by the board of directors. They'll decide whether they want to continue on issuing this dividends monthly, quarterly, semi-annual, or annually to their investors, or cut it completely. Sometimes they will decide to increase it if they see that they are generating more profits over an extended period of time. So they'll reward their investors with this form of payment. Now, the next point is diversification, and this is key. especially when it comes to investing within the stock market. Within the stock market, there's 11 sectors. And you don't want to put all your eggs in one basket within one sector. When it's time for Easter, when you buy that Easter basket, does it come with the same chocolate or the same toy? Not necessarily. It comes with a variety of toys and a variety of chocolates or candy. So it's the same thing when it comes to the stock market. You want to be able to have different stocks, different companies, just in case one performs way better than the other and one of them are depreciating rather than appreciating. Well, that one winner will offset the losses that you had within that one loser. So when it comes to investing within the stock market, you want to be able to stay diversified, as prices will fluctuate dramatically up and down, whether it's a growing company or a mature company. Now, the next point is do your research. Now, when it comes to doing your research, you have to have a good understanding of what companies you're going to be investing in. Reason why I say that is because just because the numbers that I showed you on my Excel sheet, the performance that I had within the last 4 years, does not mean that you will have the same performance within the next couple years. We don't know where these companies will be trending in regards to their stock price and how their company performance as a whole. So when it comes to investing within the stock market, by all means, please do your own research. Never take suggestions based off somebody's performance, previous performance in that essence. And also make sure that you are comfortable enough with the risk reward. Remember, when it comes to investing within the stock market, it is very risky. There is no guaranteed returns. But if you do your homework and you also know the company fairly well and know how the company runs, then you will most likely do well when it comes to investing. Now, guys, I want to say thank you to those who have stayed all the way towards the end of the video. The next video is going to consist of ETFs, and then from there I will be talking about my portfolio and also giving explanations in regards to specific companies within my portfolio and outside of my portfolio, to give you guys a better understanding of what you should be looking for when it comes to investing within the stock market. Now, please don't forget to please like the video, hit that subscribe button, and also share my video, as it would help the channel to grow. I hope all you guys have been safe, stay blessed, and thank you.